10 adjustments to get to normalized EBITDA, the way it's done in real investment banking deals. Everyone talks about adjusted EBITDA, but what exactly are we adjusting? And how do you know what should stay and what should go? And most of all, why does it need any kind of adjusting in the first place? If you've seen any deal documents or investor presentations, you'll often notice these lines: EBITDA adjusted for one offs or normalized EBITDA post restructuring. Today, we'll go step by step through the 10 most common adjustments used in real investment banking deals. We'll understand the reasoning behind each one, and by the end of this video, you'll be able to explain why EBITDA needs to be normalized before using it in valuation. So let's start. What you learn. Here's what we are going to cover in this particular video. First, why we adjust the reported EBITDA in the very first place. Then, the 10 adjustments most deal teams make in practice. Third, how to explain each one in interviews. And next, and lastly, there is a small mini case at the end where we'll see how each adjustments can completely change the valuation outcomes. So if you're preparing for investment banking interviews or you just want to understand deal logic better, stay till the end. This topic alone can make you sound like you've worked on real transactions. Let's start. So, in this slide, what exactly is normalized EBITDA? Let's begin with this concept. Normalized EBITDA is reported EBITDA adjusted for non recurring, non operational, or one off items. The goal is simple: to reflect the company's steady state operating performance. Ask yourself this one golden question before making any adjustments: would this item repeat every year under normal operations? If the answer comes out to be as no, then probably it's an adjustment. Let's see in the next slide. Let's start with the first adjustment: one off gain or losses. This is the simplest one to spot. Suppose that a company sold an old piece of land, or received an insurance claim, or paid a big legal settlement against a litigation. These are one off items. They won't occur every year. So they are not a part of regular business either. They either inflate or deflate the reported EBITDA unnaturally. In a normalized view, you remove such gains or losses because they don't represent the ongoing operations. That's now not how a regular business functions. Next, the non operating income and expenses. Remove the items that have nothing to do with the core business. For example, dividend income from an investment, any kind of foreign exchange gains or losses on financing items, or fair value adjustments on financial instruments. These may affect the reported profit, but they don't belong in operating performance. Normalizing means focusing only on what business actually does to earn the money. As simple as that. Moving on, in the next slide, the adjustment for management or owner's remuneration or the salary. This one's common in private businesses. Sometimes the owner pays themselves an unusually high or low salary compared to the market standards. For example, a founder drawing a 3 crore per year in a business that would normally pay just around 60 lakhs to hire a CEO. We have to adjust this to bring it back to the market levels. Because when a buyer will value the business assuming a normal cost, they have to look at the normalized salaries as well, and not an inflated or a discounted one. Yeah, hence you normalize your management or owners remunerations as well. Next, related party transactions. Related parties mean that if you're indulging in any kind of transactions with either a sister firm or from a firm whose founder is related to you, or it's not like a regular business. Related party transactions can distort EBITDA in both ways. It may make it higher or it may make it lower. Maybe the company buys materials from a sister firm at below market prices or rents property from the owner at the discounted rate. In either case, we replace it with what would have happened if this transaction would have taken at an arm's length. Meaning, if this related party would have been replaced with a regular vendor or a regular client. At that kind of a situation, things would have been normal. The pricing would be fair, it would be not biased. And the idea is simple, it is to simulate how the business would perform under independent and fair ownership. As simple as that. Yeah. Hence, we need to be on the lookout for these type of related party transactions. Next, the adjustment for non-recurring professional fees. This is easy. Any kind of legal, advisory, or consulting fees that are not part of regular operations. For example, audit fees are regular. Every company, every listed company has to get their financials audited and they pay the fees to the auditor. This is regular, this is normal. However, the due diligence cost as a part of a merger or a fees paid to an advisor for a one time restructuring is definitely not a regular expense. It's a one time expense. These have to be removed because a buyer would not expect these kind of expenses to incur every year. They are non recurring in nature. Yeah. Let's move to the next type of adjustment, the restructuring and redundancy costs. When companies reorganize, as in, let's say when they're shutting down plants, changing teams, or laying off staff, those one time costs definitely show up in the P&L. But once the restructuring is complete, these costs will not repeat in future. So you have to normalize them, you have to add them back while calculating your normalized EBITDA. However, be careful. If a company is doing some bit of restructuring every year, they're realigning their strategy, they're realigning their product, they're fine tuning every year, then it's no longer a one off. You need to take a judgment. Read the notes to account, read historical notes to account, and see if certain things are repeating every year or not, and accordingly normalize. Next, the adjustment for any kind of unrealized foreign exchange losses. Many companies, especially which have to import or export their services or offerings, they record mark to market losses on foreign currency loans or receivables. If a company has an exposure to credit from foreign banks, or they're supposed to receive money from clients which are outside the domestic country, in such situations, the mark to market losses, they are nothing but they are accounting entries. They're not actual cash losses. They may reverse when the currency move the other way. The exchange rate moves the other way. These are notional. So, unrealized FX losses are usually added back unless they reflect a genuine ongoing business exposure. If it is continuously happening, if it is regularly happening, and you feel that it may be existent for a very long time, then you may have to look at it. Otherwise, you have to add them back. Next, the goodwill amortization, the adjustment for goodwill amortization. Now, this is a non cash accounting charge that comes from past acquisition. Yeah. It doesn't impact the underlying operations of the business. Hence, it's added back. Amortization can differ widely between accounting standards, but the economic logic remains. It's a book entry, not an ongoing cost. It will not happen on a recurring basis. Goodwill, when it comes to investment banking, it's something which arises when a buyer or a acquirer is taking over the target company, and goodwill is nothing but the excess of the purchase price over and above the book value of the target company. And if the resultant entity does not perform as per the expectations, it does not justify the premium that was paid to acquire it, then you may have to mark down the value of the books in order to make it comparable to the market value. The market value will go down if your resultant entity is not performing. Yeah. And doing that, you may have to look at goodwill amortizations or impairments in that case. Yeah. Next, the share based compensation. This one is a bit debated, but you may show both the views. Technically, share based compensations are non cash. So they are often added back when calculating EBITDA. However, they do represent a cost to the shareholders through dilution. So, in true economic sense, analysts adjust for it differently depending on the context. In interviews, do mention both the perspective. It will show that you are looking at all the possible aspects of this. The next adjustment, normalizing for working capital or seasonality. In businesses where earnings fluctuate due to seasonality, like retail, travel, or consumer goods, you may need to adjust the EBITDA for timing effects. For example, if the year end of the company happens right after the festive season, then chances are very strong that the inventory might be unusually high. And in such situation, you have to normalize. You normalize that to show what EBITDA looks like under steady state working capital. That inventory level does not represent the regular inventory level that the company may hold. So you need to normalize it. Yeah. Now, next, let's look at a mini case where we put together some adjustments. Suppose the reported EBITDA of a company is 100 crores. And after you've seen the financial statements, after you've checked the notes to accounts, you observe that there is a 5 crores of legal settlement. Then you have a 3 crore of FX losses, 2 crores of inflated owner salary, and 1 crore of due diligence fees. Now, these are examples of all the points that we spoke of earlier in the video. Either they are one off, like legal settlements, FX loss is an unrealized expense, inflated owner salary does not represent the regular market conditions, and due diligence fees is a one off item. It may not recur every year. Hence, all of these adjustments, all of these individual things have to be adjusted back to get a normalized EBITDA. And when you normalize, you simply add these one offs back or adjustments, and you get a normalized EBITDA, which turns out to be 111 crores. And this is the number that you would use for valuation, the one that represents sustainable earnings power and hence a sustainable valuation for the company. Now, next, let's try to understand why these adjustments matter in valuation. These adjustments can completely change how a deal looks. A buyer values the company based on normalized EBITDA and not the reported number. Even a 10% difference in the EBITDA figure can shift the valuation by crores. For instance, investment bankers or valuers, they simply look at the EV EBITDA multiple of a particular industry or a particular target sector in which your company is operating, and they will use that multiple and apply it to the EBITDA of the target company. Yeah. Let's say industry multiple is 10x. And if your EBITDA is somewhere around, reported EBITDA is around 16 crores. And according to this logic, EV by EBITDA multiple times the reported EBITDA of the company will be 10 times 16. which gives you 160 crores as the valuation on the target company. But you observe in the notes to account that there are at least 4 crores worth of adjustments. You have to add back 4 crores as adjustments. So now your normalized EBITDA has changed to 20 crores. So now what is happening? Your industry multiple times your normalized EBITDA now changes to 10x or 10 times 20 crores, which makes it to 200 crores. Your valuation has swung by 40 crores. 160 crore did not represent the sustainable valuation or the actual business capability of the company. Why? Because the reported EBITDA did not have those one-offs. Normalizing your EBITDA gives you a true picture of your business, the sustainable capacity of your business, and hence the valuation should also reflect the sustainable business capability of your company, which is getting reflected in 200 crores valuation. If you're working on an M&A deal or building a model, remember, valuation doesn't reward one-off profits. It rewards repeatable cash flows, as simple as that. Now let's look at some of the interview tips, how to explain these adjustments under 60 seconds. In an interview, if you're asked what is normalized EBITDA, you need to answer something like this. It is the reported EBITDA adjusted for one-offs, like non-operational or non-recurring, so that it reflects the true sustainable earnings of the company. Typical adjustments include one-time costs, related party transactions, non-cash expenses, and restructuring charges. Simple, clear, confident. That's how you should give your answers, because that's how analysts deliver in the real life situation. Now let's look at some of the common mistakes that the candidates make in interview while answering this question. They add back every expense without checking if it is truly one time. They forget to remove non-operating income that inflates EBITDA. They ignore the context. A recurring restructuring cost shouldn't be adjusted. You have to go into the details, to go into the skin of the details and find out if it's exactly non-recurring or it continues over year on year. Go back, look at the historical notes to account. You'll find your answer there. Remember, normalization is just not analysis. It's part analysis and it's part judgment. Do not make it mechanical. So, what are the practical takeaways that you can have from this video? So, if you're valuing or analyzing a company, follow this checklist. Check if reported EBITDA includes any one-off items. Review the notes for accounting changes or owner-related adjustments. Always document each adjustment with evidence. When you are able to defend every number, that's when your model earns trust, and that's how you as an analyst will build trust and reputation for yourself. If you like this video, do subscribe to this channel. Do visit Wizenius.com, because that's where I teach live investment banking and I also help you with placement assistance. Thank you for watching this video. Share it with your friends, like it. Till then, this is Pratik signing off. Thank you.